I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Enjoy the interview. I'm going to belt out some questions I get all the time. People have a lot of assumptions about business value, and usually it's entirely emotionally based and not based in any fact whatsoever. So I'm going to tie some of this to facts. I'm going to validate and expunge some of the feeling that goes into it, and just kind of let you guys know a little bit about what we're seeing for businesses that are actively trading. And just to set the context, so I'm a broker with Website Closers. We've done over 2,000 business transactions. This is very much focused on online-based businesses. So internet businesses, tech, SaaS, e-commerce, so direct to consumer product sales, can be digital sales as well. So that's the realm that we're talking about. And when you're looking at brick and mortar businesses, restaurants, real estate, this really isn't that. So before I get going though, I got to put a little disclaimer. No two businesses are alike. So the art of doing a business valuation really is that. It's as much art as it is science. So what we like to do is we like to take actual trading values of businesses. So we've got databases of all of our sales. We've got a ton of information about all of our listings. And I take that information and then infuse it with some of the factors that go into pumping up the value of a business or the risk factors that reduce the value of the business. So these variables they've got a huge impact on the selling of the business. There's no real one valuation model that can give an accurate depiction of what any single company is worth. So usually what I do when people see these presentations and they've got a sincere interest in listing their business, they actually need to reach out to me one-on-one because I have to collect their financials. I need some information about their business model, how they derive their revenue to really hone in on it. But I'm still going to give you a really good overview of how this works just so you can have it in your back pocket. And when you get to the point where you're thinking about, going through the sales process, that's when you want to work with the broker directly. Humbly, I think I'm the best. So by all means, if any of you guys are watching this and you want my individual attention, you're welcome to reach out. So the real goal that I want is I want you to understand what the range is of your valuation. So there's not really so much like a pinpoint of a price. And the range can have a really big effect because if you go on the high side of the range when you're listing your business, you have a smaller pool of buyers. If you go in the middle, you get a larger group. And if you go on the low side of your range, you get more buyers that way too. So the range of your valuation can be helpful for you in a couple of different ways. What's your motivation and what's your timing? If you need to move quickly, then you want to list towards the middle or lower part of your range. If you've got some time on your hands and time's on your side, you want to list towards the higher part of your range. For businesses that are being sold for less than $2 million, typically we use what's called SDE, Seller Discretionary Earnings. I'll get into a little bit of that here in a second, but it's essentially, it's your profit, it's your cash flow, it's what you're actually making in your business. And then we add back some of the discretionary expenses. So that could be something like your automotive expenses, your salary, if you've got travel expenses, that sort of stuff gets put in there. SDE, it's the net earnings of the business on an accrual basis. Remember, if you have any inventory, you've got to be doing your books in an accrual basis because the importance of that is your cost of goods is basically a crapshoot when you do it based on cash. We have to know what's the inventory starting point at the beginning of the month and what's the inventory at the end of the month. And we have to know that every month so we can see what the true cost of goods is month over month. And that affects profitability. If we don't do that, we can't actually see, whether you're making money or losing money. Because let's say you do a big PO and you order a bunch of stuff in June, and then you're chipping away at that, June, July, August, September. If you're on a cash basis, you entered like a $200,000 order in June. Or maybe you didn't actually enter it until you received it. So you made the order in June. You didn't receive it until August. So you entered in August. It's all the timing screws it all up. So doing it based on accrual is really important. So you can have this nice smooth line of inventory so that buyers can see that. So SDE is the net earnings of the business on an accrual basis plus the reduction. So this is a double negative. So this is plus the reduction of interest, taxes, depreciation, and amortization. So you're actually, you're adding in whatever reduction you took for interest, taxes, depreciation, and amortization. That basically brings your SDE up. Plus all of your expenses, which are addbacks that are considered personal to ownership. So this is stuff that these are like benefits to the owners of the company. Then also you add in the one-time business expenses that a buyer would never have again on this business. There's different valuation methods that can be used. We've got some where we're looking forward and we'll do a discounted cash flow model, which is where we're looking at, you've created a projection or pro forma of what your business will be selling over the next 12 months or so. That makes a huge difference in what is possible for us selling your business, but you have to hit those numbers. You can't just say, oh, I'm going to sell $10 million by the end of the year, and then like not even get close to it month over month, because the selling process is just that. It's a process. From the time you get a letter of intent to the time you go through due diligence and you get to closing can take several months. And the buyer, if you list that you're going to make $10 million by the time of closing and you're not hitting a realistic trajectory of doing that, the price is going to get renegotiated. It's just not going to work. Let's get into the different valuation methods. I talked a little bit about the discounted cash flow model. There's also future maintainable earnings. There's relative and historical earnings. There's assets that are valued. If you're a manufacturer, for instance, you may have a lot of equipment. There's other, hard assets and stuff that go into the business. Then there's comparable company analysis. So that's kind of where we as a brokerage sit. We're doing a lot of comparisons with other companies that are selling. That's really important. Then there's also valuation models that are straight line trailing 12-month analysis. So you're looking at the trailing 12 months, or remember at this point in time, you're keeping good financials and you've got monthly financials that you can look at. So we can do an analysis based on that. Again, that's where we get into the financials, where we have to do that one-on-one because every business is so different. Some other factors that affect your business valuation: number of employees. Are you a single operator, or do you have a whole team? Do you have a C-suite, C executives, CFO, CEO, those sorts of folks? What's your infrastructure like? What is your growth trajectory? What's it been year over year in the past? And what's it looking like in the future? What are your value propositions? What other risk factors do you have? And then something else that's really important with the business is, what's the market demand for it right now? The business model, something else to talk to about business models is it direct to consumer, e-commerce? Is it direct to consumer through Amazon only? Is it a SaaS? Is it a digital marketing agency? Are there other digital products that sells within it? SaaS and high monthly recurring revenue companies are valued entirely differently. I'm not really going to get into them in this. Let's jump into addbacks. This can get highly complicated, so I'm going to try to keep it summary level, but this will probably still go over most of your heads, and that's totally cool. If you have questions for it later, it's no big deal. The key thing is, if you have good, well-formed tax returns and you've got financials, I can figure all this shit out for you. You don't have to worry about this stuff. And I'm going to do that because it gets you more money, and because I'm a sales side representative broker, I get more money too. So the more money you get, the more money I get. So it's in my best interest to get you a whole shitload of money. On the addbacks, these are owner benefits. The biggest one is your salary as the owner. Now, if you've got multiple owners, sometimes we can add back all of the salaries, but ordinarily there's a percentage that you can get away with. And it depends too on whether you're working day in and day out and you're doing the grunt work, or if you're just kind of on payroll and you're not really doing anything. I've got one client that he's basically outsourced himself out of a job, or he's delegated himself out of a job, and he just collects $120,000 a year. And we talked about listing his business a couple of different times. And he's like, well, how much can I get for it? And well, right now I'm collecting 120 grand a year and I'm not doing anything. I've got an office manager that handles everything. So like, that's kind of an interesting scenario. But in that case, 100% of his salary is an add back. Also, we can figure out too whether there's a generalization that's this. So if there's a way to outsource some of what the ownership is doing, that's also something that we can add into as an add back. Part-time customer service. So here's something that's interesting too. If you've got a relative or a nephew or someone who's doing like the customer service and handling the emails, and you're paying them like $20 an hour versus what a $4 an hour or $5 an hour virtual assistant should be doing, we can add the difference of that back as an add back. Other add backs are owner deductions. So if the owner has health and life insurance that the business is paying for. See, these are really good examples of good tax write-offs. As long as they're identified and we know what they are, go ahead and write these off. But we're going to add them back into the business profit so that you get a multiple based on this.
Why Nate is hard, like going so deep on this, is because it's super important. And I figured this out with working with him. So when we do this add backs, the whole point of this is, you have a multiple. Your business will have a multiple in how your business is valued. Okay. Let's say for good math, your multiple is 4x, right? So that means that for every single dollar of profit that your business has, you should get 4 times that for the last 12 months, that is 4 times that in the purchase price or the asking price. That's the goal. Now, you want that profit number to be as high as possible because then it's math. You get 4 times that number. So what Nate is doing right now is taking and finding all of the different things you can add back into that number. So in other words, for every dollar you can go and find in the SDE or in these other expenses he's listing out, you're going to get $4 back on the sale. Okay. Yeah. That's super, like, was it a pain in the ass for me to do it personally? Yes. But I knew that for every dollar I found, I get 4 back. So it's worth it. So anyway.
Yeah, let's go get more money. Life insurance may be like $10,000, $15,000. That's $40,000, $50,000. So it's super important. And when this is now, let's go to a comment on your bookkeeper. Now that everybody's keeping good financials and they've got a bookkeeping system, breaking out if you've got staff health and life insurance and ownership health and life insurance. Different line items so that we can easily find those, because we can't get the same benefit from staff health and life insurance as we can from our ownership health and life insurance. Same thing with 401k works exactly the same. You get the benefit of your 401k as that multiple. So for every dollar that's an expense to the company because it's paying your 401k, that's actually 4x, 3x, 4x, 5x. And money back in your pocket when you sell the business. Meals, especially if they're catered, doing catered meals, if your meals on travel, that sort of stuff, we can put those back in as add backs. Business travel. This one's actually pretty crafty. I've heard this story a couple of times. I don't see it broken out in financials very often because most people, they're lazy about their financials. But your credit card points and your cash back that you've used for personal benefit. So let's say this is a really good example of what like an ad agency can do. If they're doing their ad spend like through the agency, like clients are paying them and then they're doing the ad spend. Affiliate networks do this a lot too. And affiliates and ad agencies, they'll use their American Express card and they'll amass a massive amount of points. Millions. I've got friends that have got 3 million, 6 million. I had 3 million points at one point in time with our ad agency. I didn't know this. You can add that back as a benefit for the new buyer too, because you've been using that credit card and then you've taken that for personal benefit. It's a great tax incentive. You don't get taxed on that. So this is kind of like a double whammy. Like you can really get some extra value in your business too, but you got to show those statements that they can actually see and can verify that you've got that. So it holds through in due diligence. But that could be a monster amount of money because the cash value of those can actually add up to some significance as well. Then we've got some simple things like cell phones, your telephonic usage. If you've got a vehicle that you're leasing, that's usually a very easy add back. If you've done any charitable donations, those are add backs for you as well. Now, let's get into the one-time expenses, some common one-time expenses. I want to get your brains working on what are some one-time expenses. So these are like kind of some startup expenses, some things that you did in the beginning that the buyer's not going to have to do, right? One of them, trademarks, copyrights, patents. If you have to go back and recast your financials and build your books from scratch. Usually there's a cost associated with that. There's some CPAs and tax professionals and consultants that'll do that for you. It could cost you anywhere between $2,000 and $5,000, maybe as high as 10 if your financials are really, complicated. If you add in that accounting software, that expense, that's also a very fair add back. If you've had a one-time operational improvement, so a really good example of this is, let's say you're selling a product that you're sourcing from China, and you're paying $4 a unit for it, and then you renegotiate that for $2.50, and then so that's $1.50 change times the number of units for the last 12 months. That could be tens of thousands of dollars, hundreds of thousands of dollars, because you negotiated that. You've made an improvement that the buyer is going to reap the benefit from, but on your current financials, they are depicting the higher cost that you had, that $4 cost per unit. Now it's only $2.50. That's an add back. Throw that bad boy in there. Same thing with shipping and fulfillment. So if you've, I had a client that had this situation where they were sending out their fulfillment company incorrectly. They were furious about this. Was sending out two packages for products that should have been bundled together. So instead of taking the first product and the second product and put them in the same box, they shipped them out individually. So the shipping cost was twice as much. Their pick and pack fee was twice as much. The fulfillment company got fired, but that's a great example of an add back. So here's some that you guys might be considering. What about websites and redesigning websites? That one depends. If you are frequently updating your website and optimizing and adjusting for conversion, for the highest conversion you can get, probably not going to be considered as an add back. But if, for instance, you've got a business that one time every 5 years, doesn't get redesigned, that's a good example of an add back. We can quantify that. So here's some not add backs. If you have an e-commerce product or you have a digital product and you're doing product development, you're doing iterations to it, you can't really get away with that as an add back. That's just continual maintenance. For people who have tech and SaaS and digital, technology related, internet technology related stuff, the initial architecture and or switching tech stacks, like if you move from one server system to another, that could be qualified as an add back. I'd put it in there. You just have to see what the buyer has to say about that. Remember, this is all the negotiation between a seller and a buyer. So the seller, they put it all out on the table, and the buyer, they chip away at stuff that they agree with, they don't agree with, and that becomes a negotiation. From a tech perspective, your maintenance and your enhancements, that's not going to qualify as an add back. Events, masterminds, trade shows, so things that are personal development related, if it's attendee and peer groups, those are add backs. So boom, slap that in there. If it's personal development where like you're sponsoring something and you're advertising something, that one you're not going to get away with as an add back. That's an advertising cost. Also, if you send employees to trade shows and conferences, that's not an add back either. Not that you shouldn't, you just won't get that as an add back.
The point of distinction that's really important with add backs and all this is that it just has to be around you, the seller. Like it has to be involving you and for your benefit. So I want to just stop and say, this is why I love you, Nate. So as you were going through this, I had my calculator out here. You just found me another 150 G's, literally. So check this out. Yep, I know, right? So I want to make sure, I'm going to have you fact check me here, but all of you watching this, go find your money. Nate's giving you money to go find right now. So for me, I've got a SUV that I lease through the business, $800 a month times 12, right? And then I've got a cell phone for my family, whatever, $500 a month times 12. And then I've got $10,000 worth of rewards points on my credit card in the last year that I haven't touched. And then I tithe, so $1,000 a month times 12, charitable deduction. I take all those numbers and then I multiply them by, let's say 4. Let's say that's my multiple. 150 G's right there with those 4 things.
When you're listing a business, it is a point in time that you list. And then every month we update the financials. We republish. So we go back out there, we relist, we communicate this to everybody else. We do this big rain dance, our seller had this, this last month, they kicked ass. They did great. God, you guys have been sitting on the sideline. What are you waiting for? Oh, by the way, the price has gone up because they're worth more now than they were last month. So we do that every month. So that's really what we do to get some excitement. And I did that for one client, and it was so monumentally large for them. We had a $12 million ask price. I got them under contract for $18 million because the value that they had gone through in 45 days increased their company valuation so much that they wouldn't sell at $12 million. They shouldn't sell at $12 million. And somebody agreed to pay him 18. That's the deal. That's the art of it.
That is amazing. So when Nate takes 10 minutes to thoroughly go through this stuff, you should take 10 minutes to thoroughly go through it. Because I just in 30 seconds found 150 grand. One of his clients, they found another 4 million in 45 days. I mean,
that for them was, so we're actually going and doing an addback study with them as well, because they've got a situation where their manufacturing costs significantly reduced, and they had one too where their shipping costs significantly reduced. So now, even though they're under contract right now, there's still some wiggle room that they can use before they have to, declare their final financials before closing. So like they're going through this process right now with the financial consultant, helping them like dig through their invoices and that kind of stuff. So they got from 12 to 18 million because their revenue just went crazy and their profitability went crazy. So that was a trigger for the higher price. But even now, what's going to be helpful for them is every dollar that's on that is an SDE, a seller discretionary earning, or people use EBITDA a lot, earnings before interest, taxes, accrual, and appreciation, or depreciation and accrual. So basically the same thing. What's the actual owner profit? Like you said, this is all for owner benefit. So if you're, pulling some points out here, you're doing some, some charitable tithing here, that sort of stuff. That's all what you're doing because you as a business owner have elected to do that. Yep. The buyer may not do that. Maybe he, may or may not be, be doing tithing. If he does, I mean, that's a personal thing for him. That's not actually a business expense. We get away with it because it's a charitable donation. And from a tax perspective, it's great. And we also, love who we are, doing charitable donations too.
For those that are watching, I was in your shoes not long ago, and I know this sounds like a lot of work and very complicated, but it's not. And this is why it's really important to connect with Nate or someone on Nate's team, or someone that knows what they're doing.
The great news about this is you don't have to do any of it. No. We do all the hard work for you.
You shouldn't even try to do any of it.
I wouldn't. The first time your engine blows up, do you really want to drop the engine and try to fix it on your own in your garage? Take it to somebody else. Let the mechanics that are the professionals handle it. You're going to get more money. You get back out on the road that much quicker. Thanks for watching. If you like this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.